So, colleagues, just a couple of reminders as you join us and as everyone joins in. That remember that your platform doesn't allow your camera or your microphone to go on whilst the speaker is in progress, and you will have a chance though for your cameras and videos to go live when you do visit the booths or during networking tables sessions that you take up. Remember to post your questions in the Q&A section. It's an invaluable opportunity for all of us to learn from your thoughts as well, and things that you might want to find out, others might want to as well. Please do complete the evaluation forms in the delegate handout, which you can find on the right-hand side of the panel where it says handouts. And if there is a challenge, please drop us a note and we'll assist. We're looking forward to another session, and this one is an age-old debate. It speaks to expectation gaps, and it gives me great pleasure to introduce a person who is a colleague appointed as Acting Chief Executive Officer of the Independent Regulatory Board for Auditors, the IRBA as we know it, after fulfilling an 8-year role as the Director of Inspections. His career spans several small and large auditing firms, including PwC and S&G Incorporated, and he has more than 20 years of experience in the audit environment, particularly in terms of regulation, audit quality, quality control, and performing audits. He has also experience in accounting risk management, forensic audit, and public sector advisory. Ladies and gentlemen, it gives me great pleasure to welcome to speak today on fraud expectation gap versus the audit expectation gap. Let's give a warm round of welcome to Imre Nagy. Welcome, Imre.
Thank you very much. Really appreciate the opportunity to address everybody today. I hope you're all keeping safe and keeping well. Raj, I have a presentation that I'm sharing now. Can you let me know when it's visible on your side? So I've shared it. Not sure if you can see it.
It's not come through yet. There we go. We're all good to go. Thanks, Imre.
Excellent. Thank you very much. So good morning again. I hope you're keeping well. I would like to thank you, Raj, for that kind introduction. I would like to thank the ACFE for inviting me to speak at this prestigious event. And I trust that my presentation will be of interest and of value to you. Today, as Raj has introduced, today I'll be speaking to you about the fraud expectation gap and the audit expectations from an external audit perspective. I think you'll all agree with me that one of the hottest topics in the external auditing world today is the so-called fraud expectation gap or audit expectation gap. So what exactly is this expectation gap and what does it mean? The International Auditing and Assurance Standards Board, the IAASB, recently issued a discussion paper on fraud and going concern, defining the expectation gap as the difference between public perceptions about the role of the auditor and the auditor's responsibilities in a financial statement audit. In more general terms, it refers to the difference between what the public expects from auditors and what auditors actually provide. And I'm talking about external auditors, not internal audit or other audits. There is no doubt that external auditors play an important role in the financial system by performing external audits. Whether the gap is caused by weaknesses or failure or concealing of fraud or underreporting on fraud, auditors need to do what is required in the public interest to protect investors. While the current standards do not extend to expect fraud detection by auditors, there is a strong call on auditors to do more. It is widely believed that there is an opportunity for external auditors to apply more professional skepticism by, for example, challenging and questioning management and management assumptions. The International Standards on Auditing, ISA 240, defines fraud as an intentional act by one or more individuals among management, those charged with governance, employees, or third parties involving the use of deception to obtain an unjust or illegal advantage. It would be unthinkable for external auditors to be involved in committing or concealing fraud together with management, considering their high ethical code and standards. However, we will look at perceptions in this regard in a few slides. Although fraud is a broad legal concept, for the purposes of the ISAs, the International Standards on Auditing, for the purposes of the ISAs, the auditor is concerned with fraud that causes a material misstatement in the financial statement. So their fraud focus is very specific to material misstatements in the annual financial statements. Two types of intentional misstatements are relevant to the auditor: misstatements resulting from fraudulent financial reporting and misstatements resulting from misappropriation of assets. Although the auditor may suspect or, in rare cases, identify the occurrence of fraud, the auditor does not make legal determinations of whether fraud has actually occurred. And that's in terms of ISO 240. This topic in relation to the auditor's considerations relating to fraud is not only important for South Africa, but is being considered internationally by international standard setters and regulators. I'm sure that as professionals, you and I are well familiar with the fraud triangle, highlighting the drivers of fraud. So I will not go into further detail now, but you're welcome to look at it in the slides after the presentation. Let's rather dive a bit deeper into what caused the fraud expectation gap. So, in essence, it was caused by high-profile corporate failures, which created a global crisis of confidence in financial reporting. Several jurisdictions experienced significant corporate and/or audit failures in the recent past, with sensational coverage in the mainstream media. For example, Steinhoff, the public wants to know who committed the accounting fraud, what happened. But we have other, I'm listing a few, Wirecard, there were allegations of fraud and misstatements, Luckin Coffee with inflated revenue, Wells Fargo with false accounting, and the list goes on and on. But though the size of these corporate failures may differ across different jurisdictions, they all follow a familiar pattern whereby investors lost their investments due to elements of fraud. These events increased investor expectations for auditors to do more in relation to preventing corporate failures that were caused by undetected fraud and unidentified risks. These sentiments are exacerbated by media publications implicating auditors in these failures and generally criticizing the audit profession for failing the public. But there's been a tendency among investors and the media to blame the auditors first, often overlooking those who committed the fraud in the first place, the masterminds behind it. This tendency, however, is also changing as we now see more and more fingers pointing to those who failed to execute their primary fiduciary duties within these corporations. As we further explore the expectation gap, what it means, let's have a look at the three gaps. In May 2019, the ACCA issued a report titled Closing the Expectation Gap in Audit. This report is still relevant today in the context of understanding and responding to the fraud expectation gap. And their report identified three main components or gaps. Firstly, there's the knowledge gap, referring to what the public thinks or think auditors do versus what auditors actually do. Secondly, there's the performance gap, referring to what auditors actually do versus what they are supposed to do in terms of the standards. And lastly, there's the evolution gap, referring to what the public expect auditors to do. The consolidated view of the stakeholders surveyed, and South Africa formed part of this survey, and that is why I'm quoting this, But the consolidated view of the stakeholders surveyed is that each component, the knowledge gap, the performance gap, and the evolution gap, contributes to the audit expectation gap in a significant manner. The evolution gap is a common concern shared by regulators and those charged with governance. Concerns raised include whether the audit product and consequently the standards that support the audit product are evolving at the same pace as business, and whether they can keep up with the evolving business models, information systems, and accounting standards that are more judgment or estimation based today than they were a couple of years ago. We have learned from our discussions as the IRBA with audit committees, fora, CFOs, key stakeholders, as well as from what is being reported in the media, that the public is expecting auditors to do more in relation to preventing corporate failure caused by undetected fraud and unidentified risks, which could adversely, obviously, impact on the financial stability and the long-term going concern of corporations that investors invest in. Each participant in the financial reporting ecosystem plays a unique and essential role that contributes towards quality financial reporting. That ecosystem of, or you could say the value chain of integrity in the financial reporting system, there are role players there, right from the beginning of within the businesses, right until the end, where the financials are audited and the reports are issued to users such as investors, SARS, banks, etc. It will take a significant effort where we are, if we see where we are now today, it'll really take a significant effort from all participants in this financial reporting ecosystem to bring about meaningful change and improve financial transparency. So who is responsible for fraud prevention and detection? Remember, I'm coming from an external audit perspective. So the auditing standards ISO 200 assigns the primary responsibility to preparers, management, boards, audit committees, and those charged with governance, who are primarily responsible to implement controls that would prevent and detect fraud and ensure fair reporting. Internal auditors and forensic experts also support this primary responsibility. The external auditor's obligation is, however, a secondary responsibility, and in terms of the extant standards, auditors are not primarily responsible for detecting fraud, but they do have an obligation to consider the impact of fraud on the financial statement audit, including obtaining reasonable assurance that the financial statements are free from material misstatements due to fraud or error, identify and assess fraud risk, obtain sufficient appropriate audit evidence, and respond appropriately to fraud or suspected fraud. And most importantly, apply robust professional skepticism. And that is a behavior of being alert to conditions that may indicate fraud. Investigate inconsistencies, for example, and discuss among team members fraud susceptibility and how fraud might occur in a particular entity that they're about to audit. Expanding a little bit on that, I would like to highlight some of the most important international standards applicable to external auditors with a focus on fraud. It might be a bit technical. Apologies for you that know these standards. But for those of you who are not familiar with the external audit standards, this might be a useful tool in better understanding the fraud expectation gap. So the first standard that I'm highlighting is ISO 315. It deals with the auditor's responsibility to identify and assess the risk of material misstatement in the financial statements. Like I said before, it's very specific. And to do that, they need to obtain an understanding of the entity and its environment, including the entity's internal controls, to detect and report fraud. ISO 540 deals with the auditor's responsibility to address requirements to understand simple accounting estimates, for example, provisions on inventory impairments, and complex accounting estimates such as the provisions on intangible assets or goodwill impairment. ISA 330 is linked to 315, and it deals with the auditor's responsibility to design and implement responses to the risk of material misstatements identified and assessed by the auditor in accordance with ISA 315. So ISA 240 deals with the auditor's responsibility relating to fraud in an audit of financial statements. Specifically, it expands on how 315 and 330 are to be applied in relation to fraud. And a little bit later, I'll share with you some of the inspection outcomes of the IRBA at firms in terms of these standards. So with this background, let's now have a look at a few case studies to gain some practical insights. So case study 1 is on African Bank. And this is really at a very high level, but in essence, the bank was placed under curatorship back in 2014 after it collapsed following years of reckless lending and bad debt. An unqualified opinion was issued in 2013 and in the prior years, and the auditor was found guilty on 5 charges, mostly relating to flawed audit work, lack of professional skepticism, and not identifying or addressing material errors, including loan loss impairments and discount rate errors. The auditor's right to practice was suspended for 2 years with strict conditions, and a monetary fine and cost order totaling 32 million rand was handed down. The auditor was, however, acquitted on the dishonesty charge. Let's look at a second case study, and this is on Linkway Trading. Charges including audit work relating to transactions for a lavish 2013 wedding. The partner faced 6 charges of improper conduct, each with several sub-charges, and all charges emanated from the 28 February 2014 audit. 2 of the 6 charges involved allegations of dishonesty, 3 charges related to negligence, and 1 charge related to a breach of auditor independence. The auditor's registration was cancelled and his name was removed from the IRBA register, and the auditor was ordered to pay a contribution towards the IRBA's legal costs. The auditor was also barred from the South African Institute of Chartered Accountants, SAICA. Lastly, let's have a look at a more recent case that played out in the Netherlands, but involving SA-based Steinhoff. So the Netherlands Authority for Financial Markets, the AFM, lodged charges against the auditor and issued the outcome late July this year, 2021. The auditor had issued an unqualified audit opinion in 2016. A PwC report later found former Steinhoff executives had inflated the group profits and asset values by more than 100 billion rand through fake transactions and accounting tricks from 2009 and 2017. 6 charges were leveled against the partner by the AFM, including that he did not properly evaluate the sale of intangible assets, that he failed to obtain appropriate audit evidence, and he was found to be insufficiently critical of his assessments, which links back to professional skepticism. The auditor was found to have acted contrary to the fundamental principle of professional competence and due care, and he was found guilty on all 6 charges, and his registration as an accountant in the Netherlands was suspended. So following these, I just demonstrated to you a little bit around, some of the cases that are playing out, but there's a lot more. But following these and other high-profile cases and looking at the outcomes of our regulatory inspections, one can start to identify possible root causes that led to these high-profile audit failures. As the audit regulator in South Africa, after we concluded our inspections process and issued our final report to the audit firm, we follow a mandatory remedial action process with them, whereby those with reported deficiencies must submit to us a written root cause analysis and action plan within 30 days. We review these plans and discuss them with the firm leadership and the relevant engagement partners. And from our assessments, it became evident, and this is important, it became evident that most audit failures are not only linked to poor audit quality, but they rather have a lot to do with auditors behaving unethically, not exercising sufficient professional skepticism, and not acting independently. In the area of accounting estimates and judgments, including reliance on experts, there was a lack of understanding of the purpose and the process of, or a lack of professional skepticism demonstrated, in that the auditor failed to adequately challenge management's assumptions and conclusions. Furthermore, the lack of independence, due care, or failure to comply with fundamental principles of the ethics code is particularly prevalent in instances where the auditor is either heavily dependent on the fees received from a particular client, or the client is perceived to be a key or prestigious client to be associated with. This begs the question that, and it's a big question, that had these auditors performed their work with due care in line with the current standards, would they have possibly reported and detected the fraud? So as mentioned already, the IRBA performs risk-based inspections of registered auditors. So let's have a look at some examples of our inspection findings on the work of auditors. We issued our 2020 public inspections report in January this year, and I did include the link in the last slides. So you can have a look at this report. So it's on the useful link slide that I included, and in the presentation you can access it on our website. Our report shows that fraud work findings related mainly to auditors not complying with fundamental auditing principles and risk assessment procedures. This relates to the performance gap mentioned earlier, referring to what auditors actually do versus what they are supposed to do in terms of the current international standards and ethics code. Deficiencies relating to the auditor's assessment of risk comprised 6% of our inspection deficiencies reported in 2020, which included fraud-related audit work deficiencies. To be a little bit more specific, I extracted the following examples of inspection findings that fall under the fraud risk theme. The first example relates to the absence of or insufficient evidence on the engagement file relating to the auditor's assessment of the risk of material misstatement due to fraud or error. The assessment then of the risk of fraud at the financial statement level was often combined with the risk of material misstatement at the assertion level in the same working papers. The auditor did not clearly identify which balances or classes of transactions had been identified as having possible fraud risks. In some instances, fraud risk would be identified at the risk assessment stage of the audit. However, no or inadequate audit procedures would be performed during the fieldwork stage to respond to the identified fraud risks. So, it's really a question of not appropriately following through on the risks identified. We also identified issues on the presumed risk of a presumed significant risk related to fraud in revenue recognition. The auditing standard deems revenue to be a significant risk due to fraud, but it allows for the risk to be rebutted under certain circumstances. The rebuttal of the presumed fraud risk in revenue appears to be applied as a default practice by some firms, as it requires less audit work. Auditors might indeed say rebuttal is allowed where there is a single type of simple revenue transaction. But in these instances, the auditor's justification for rebutting the significant risk was deemed inappropriate. We reported to the firms that revenue rebuttal should be justified and documented at the revenue stream and assertion levels to enable an experienced auditor to understand the risk as well as the nature, timing, and extent of the audit procedures performed, the result of such procedures, and the conclusions reached thereon. There were numerous instances where the risk assessment at the assertion level would reflect a particular financial statement line item as a significant risk. Yet again, the documented sample size or substantive controls testing in the fieldwork section of the audit file would be insufficient. In general, we identified a disconnect between the risk assessment performed on the engagement file versus the nature, timing, and extent of audit evidence gathered. These audit deficiencies, looking at the cases, the corporate failures, and looking at these deficiencies reported by the IRBA, increases the risk of the auditor not detecting, addressing, or reporting on possible fraud that could result in an audit failure. Because an audit failure is where the auditor fails to pick up the fraud during the audit and issues a clean or an unqualified opinion, and then a month or whatever later on the company fails because of fraudulent financial statements. I referred you earlier to the IAASB's discussion paper on fraud and going concern, and I thought it might be relevant to highlight some of the comments where it relates to forensic specialists. So 86 comment letters were received, and some of the recommendations that were put forward are the following. So firstly, I'm quoting from the Auditor General's letter. They noted that auditors could make use of forensic specialists as part of their audit risk assessment, particularly where they feel there may be concealed fraud or where a heightened risk of fraud is identified. They also identified that it's necessary to actively look for sources of contradictory information that could bring into question certain estimates made by management. And then utilizing fraud expertise to assist in executing certain audit procedures could prove to be helpful in this regard. They also addressed the training of auditors on forensics and how to identify risk of fraud, as well as providing additional examples of fraud risk indicators. Adopting a suspicious mindset can contribute to enhanced fraud identification and the appropriate exercise of professional skepticism at an overall audit level. Increased transparency. Currently, the audit work performed in response to fraud indicators is not reported on in the auditor's report. This may perhaps contribute to the public's view that auditors are not doing enough. Fraud related to third parties already detected by management or those charged with governance or reported on by the media or investigating authorities should be considered in terms of the impact that it may have on financial statements, as well as its possible impact on the integrity of management. There should also be a consideration of whether the auditor has any professional or ethical responsibility to alert another authority of such instances. And then to manage public perception, the auditor could also consider including reference to investigations currently underway, and engagement quality control reviews could include the assessment of and response to fraud risk at the client. So there were 86 comment letters, but I just highlighted some of them that related to the use and the value that forensic specialists could bring to the external audit process. Some further views, and let's look a little bit further than the international standard setter. So the use of forensic specialists, again, in the external audit process, the IRBA belong to a body called IFIA, the International Forum of Independent Audit Regulators. They represent independent regulators from 54 countries, and South Africa is a founding member and board member currently of IFIA. And in their comment letter, it says, and I'm quoting now, whether the identification of material misstatements in the financial statements due to fraud requires the use of specialists, and to understand the extent to which fraud investigation specialists are currently engaged or included in audit teams, and if so, what is the nature and the procedures they are performing. As the IRBA, we suggested a somewhat more progressive approach in that, and I'm quoting again from our comment letter, the auditors should have enhanced or more requirements regarding fraud in an audit of financial statements to meet today's evolving expectations of the public. However, overall, we do not believe that these enhancements need to extend beyond the scope and purpose of a financial statement audit. Mandating forensic specialists may result in this being applied more broadly not have a material impact unless this is complemented with requirements around the nature, timing, and extent of their involvement. Close quote. The FRC in the UK wrote, and I'm quoting again, risk assessment procedures and related activities requiring that the auditor shall determine whether the engagement team required specialized skill or knowledge to perform particular procedures. So they took a very direct approach, a very specific approach to mandate specialized skills in certain circumstances. Matters that may affect the auditor's determination of whether the engagement team requires specialized skills or knowledge include a possible need for forensic skills as part of the risk assessment process, and to follow up on this identified or suspected fraud. So, like I said, the UK have seemingly added a specific requirement that if the auditor identifies a misstatement due to fraud or suspected fraud, the auditor shall determine whether a forensic expert is needed to investigate further. The Canadian regulator wrote, given the increasing complexity of entities, business models, and sophistication of fraud schemes, we believe that auditors should be required to involve forensic and IT specialists more frequently during risk assessment and throughout the audit. Close quote. So I've given you some perspectives from regulators locally and internationally around the use and the need of forensic specialist skills. Okay, so from a more broad environmental perspective, the risk landscape has changed significantly due to the impact of COVID-19. New realities and expectations create a more challenging environment for the entire financial ecosystem, including the auditing profession. To that effect, the IRBA has issued dedicated guidance on the implications and considerations of COVID-19 with regards to audits and audit risk. You are page on our IRBA website, and the link, I did provide the link in the slides. Some of the risks identified include, for example, procurement fraud, especially for personal protective equipment, online fraud such as the sale of fake medical goods, fraudulent applications for government support and charity impersonation fraud. Then there's the more broad business process and operational failures such as flouting of internal controls and management override, liquidity and solvency issues, valuations and impairments. All these are impacting on the corporation's going concern assumption. And the audit of significant judgments and estimates become critical, which requires increased professional skepticism to be applied. So all these risks and the restrictions on movement give rise to significant audit execution challenges and limitations. I heard, for example, from one of the big firms that they believe that there's indeed a drop in inherent audit quality and that they are, for example, extending trainee contracts due to the lack of direct observable supervision of trainees during the lockdowns. Auditors and specialists such as yourselves indeed have to be vigilant and aware if the heightened risk of fraud in companies impacted by the virus impacts on risks and fraud and impacts overall on the sustainability of the financial reporting ecosystem. So let's bring it all together. I offer some key takeaway points. So we need ongoing awareness and understanding and continued dialogue about bridging the expectation gap across the whole financial ecosystem, including preparers, management, internal audit committees, and those charged with governance, and of course, forensic specialists such as yourselves as well. Auditors must execute their fraud-related work with the utmost care and professional skepticism to address the performance gap. And auditors must pay particular attention to the company's fraud risk management system and whistleblower system and reports. Auditors should involve forensic specialists in their fraud risk assessment and or in the audit process to help close the fraud expectation gap. And COVID-19 obviously increases the risk environment, and it therefore requires increased awareness of the increased risks because of the impact of COVID-19. Before I close, I would like to inform you that in terms of the IRBA strategy to restore confidence in the audit profession, it has issued an exposure draft on enhanced auditor reporting with several proposed enhancements, including to provide more transparency around fraud procedures in the external audit report. I invite you, please click on the link to access this very important consultation paper. Your insights and input will be highly appreciated. I do believe it's close to the due date, but please have a look at it if possible, if you have time. So here are some useful links that you might find to be of interest, and you can just follow the links by clicking on the hyperlinks that I'm putting to you here. I've included some very specific, relevant information to the expectation gap and to you as an audience. So that's it from my side. Thank you for attending the session, and I wish you all the best. I believe there are an opportunity for some questions now, but I'll gladly answer the questions and enjoy the rest of the conference. Thank you.
Imre, thank you for a detailed account of what is happening in the space, particularly in an environment that is continuously evolving. I think you may have touched on this, and I'm going to look at some of the questions now, but Moazam Feki has pushed this out. And as I say, you may have touched on it already, which we saw. But your view on given the climate and the propensity for fraud occurrences, is it not much better rather to make it mandatory to have fraud examiners assess fraud risk and supported by a specialist in the nature of fraud in current times?
Thank you. Yes, certainly in the presentation, what I tried to demonstrate was the standard setter. We follow international standards. So the starting point for strengthening standards would be the standard setter. So the comment letters that I cited in my presentation, and as you can see, prominent regulators locally and internationally are making recommendations to the standard setter that there's certainly benefit of roping in forensic expertise in the fraud identification and execution stages of the external audit. So yes, I think one has to see what comes out of the consultation paper and what the standard setter actually puts out there. But there's always the option as a local regulator, once the standard setter, if we see the standard setter in revising the standards does not maybe push it so far to make it mandatory, there's always the option to say, do we look at it locally and do we strengthen our local standards by adding an additional requirement? But I think it's a bit early days, but you can clearly see where the narrative and where the dialogue is going to. Auditors need to do more to identify fraud, because an audit failure only happens where the auditor didn't identify the fraud in the first place and reported that everything is honky-dory, whereas in reality it is not. So yes, very good comment and question. I trust that the presentation and the comment letters speaks for volumes of where regulators think the standard setters should look for solutions.
Is it fair to say that whilst there might not be a specific requirement for a fraud examiner or fraud specialist to be involved, an audit in terms of managing risk on an audit, the auditor is obliged to consider the kind of skills that are necessary. If they are specialist skills, they generally do not necessarily reside within that of a chartered accountant who's trained in accounting matters. the standards do allow for one to consider the need for other skills. So in the absence of something specific making it mandatory, there's always provision to bring in the right skills. And that's not, it's not new.
Raj, couldn't agree with you more. I believe the onus is on the firms because of the these failures that we've seen. Obviously, the standard makes provision that auditors need to consider their competency and experience in accepting an audit. And you're 100% right. That is already in the standards a requirement that you need to have a competent team to perform the audit. I think what you're touching on, Raj, is a very important aspect, and that is raising the bar. Raising the bar of what's already in the standards, and I think basically the whole theme of what I spoke about today is the call of auditors to raise the bar. And I think you touched on it, auditors, and there are really a lot of audit firms that I can really credit that they have already started to rope in these skills in the auditing process, which is really great to see that. And I think the firms are really on the right track doing that. So couldn't agree with you more. The onus is on the firms, the audit firms, to, in terms of their interpretation of the current standard, raise the bar, bring the necessary skills on board, and reduce the risk of an audit failure.
Imre, just one that now comes from Onke Poswa, and I think this is an interesting one. It takes it away a little from the focus on the auditor, because one identifies that there are gaps and that there are certain limits to which someone like an auditor can go through. What are the consequent measures that management have put in place with some of these audit failures? And how did they go about trying to detect it? Because one talks of the lines of defense in control and control environment. We start looking at the person at the tail end of the game, but has there been a deep dive into what has management done? Is there a robust way in which they have approached it? Because they should be the first line of defense.
Yes, Raj, and I think, as I said in my presentation, the primary responsibility for financial reporting is with the preparers, the management, and those charged with governance within the companies. And the secondary responsibility is that of the auditor. But what I mentioned is that I think the media, there's a tendency that, if something went wrong, the first question that is asked is, where were the auditors? And I agree. I think maybe the first question should be, how did those charged with governance miss the issues, and who committed this fraud? And then ask, how did the auditors also not pick it up? So yes, you're absolutely right. So obviously the IRBA, we only have a mandate to regulate auditors. We are not a comprehensive regulator that regulate accountants. That has not yet been adopted by the Minister of Finance, in that comprehensive regulation is a proposal currently on the Minister's desk, to ask that there's definitely a regulation needed for the broader spectrum of professional bodies. So, but currently the RBA only regulates auditors and accredits SICA. But, going back into the companies, I do believe that there's a slight shift. If you look at the media articles and what other regulators are doing in holding those accountable that actually committed the masterminds behind the fraud, those that actually committed it, those are the people that I believe should be focused on. But everybody, like I said, has a role to play in context of the financial reporting ecosystem. It is unfair to point everything towards the auditor, because the auditor was not there when that individual or a group of individuals decided we're going to cook the books. The auditor was not in the room there. And hopefully the auditor is not the mastermind after all. But but in most instances, I think if you look at these things, the auditor should be independent, things that happen in the firms, if there's risks or indicators of fraud, the auditor should be very, very skeptical and very carefully in assessing those red flags and respond appropriately in the audit. Because a fallout, none of us can afford any further.
Okay, it seems like we may have lost Imre there. Okay, colleagues. So we seem to have lost Imre in that last bit of question and answers. So I'm going to close this session at this point, and say that if there are any further questions, you can please reach out. We will close a little earlier. Just a pity that we couldn't ask the last two questions. I think one of them that Leanne had raised regarding, so, you go through all of this, the levels of review, and there's still audit failures. Leanne, I think in that last answer that was coming through from Imre, he alluded to the fact that sometimes the auditor is not in there. The nature of audit involves concealment, and with best intention and best approach, it could fall flat, but it doesn't.
Sorry, Raj. I think I dropped off there. Apologies.
Yes, you dropped off. In fact, I was just responding to one of the questions, and you probably touched on this, which Leanne raised, and she said, do you mean that the auditors, after performing an audit, submit their file with evidence for review? They conclude that the audit is supported, that even after all of that level of reviews, there are still audit failures. And just sharing that you were alluding to the fact that the auditor is not in the room when those transactions are engaged in. And quite often, because of the nature of fraud involving concealment, even that wool is pulled over the eyes. So a well-orchestrated fraud would keep many people in the dark for a long time. And one just has to look at history. Bernie Madoff and Steinhoff, they hid for a while, but it doesn't detract from an important thing, which is the next question I wanted to actually raise by Ngoni, who says he's of the view that there will always be room for compromise when an audit firm is contracted by the client. The person who's being audited is the person that is contracting you, because the client will inevitably call the shots and place that pressure where ethics might go out the window. And the question is, what are the chances of the auditors being caught? So I think we know the answer to that. That's the role of all of us being out there to make sure that it happens, and you as a regulator. But is there thinking in a different direction to where the people who are being audited are not the ones actually taking the call as to who audits?
Yes, Raj, it's a very deep topic at the moment among regulators internationally, in that there's an inherent limitation in the audit, in that auditors are reliant on fees from clients, and but they need to maintain independence. So you will see a lot of the reforms coming through, for example, in the United Kingdom, and other reforms in a number of countries where they are looking at audit-only firms, because we've also recognized that the audit firms do other work as well to the same audit client. So that's already one element that shows that there's a different relationship than an independent audit relationship, albeit not the same people, but certainly under the same brand. And to talk to you to the fundamental principle of the client paying and contracting the auditor, that is something that is currently still under debate. There are a number of proposals to say that you need to de-link the contracting and the funding of the audit from that relationship. For example, there could be a fee raised by in the form of a tax or by the JSE, for example. I'm not saying those are formal proposals, but there are different models that people have already put on the table to say, to de-link, to say the audit, there's a certain audit fee, and the auditor is totally independent from the client. As the IRBA, we have looked at many ways to strengthen independence in South Africa. For example, mandatory firm rotation, breaking firms responsible for the audit, and having a very long relationship with the same client. Breaking that or limiting that to a maximum of 10 years. Also allowing them for two sets of engagement partners, teams and engagement teams to audit in a 10-year span. And then you go at all these independence indicators, because you're absolutely right. All these failures, like I said in the presentation, there's a link back to independence. There's a link back to doing more work and to be more skeptical. For example, the whistleblowing process, excuse me, the whistleblowing process, and what controls do companies and those charged with governance have to detect and prevent fraud. So it's a very deep discussion. One could almost have an entire session just on auditor independence, but very correct observation. And yes, the profession is certainly aware of the impact of independence on the audit quality and the audit output.
Imre, thank you very much on behalf of all the colleagues present here and the ACFE. We want to thank you for your time this morning and the insights that you've shared, the very balanced view, which is one of the comments on the Q&A side, the very balanced approach, not being defensive. We appreciate that, because that is what we expect of a regulator, and we appreciate the time that you've spent with us. Thank you very much. Colleagues, we're going to break now for a tea and coffee break for all of you to have some refreshments and have a comfort break. We'll be back in 15 minutes, or shall we say 12 minutes, at 10:45. Until then, please visit our networking areas and our exhibitors' booths as well. We'll reconvene in 12 minutes.